Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
Welcome back, and thank you for joining us again for the Norris Group Real Estate Podcast and part 2 of our episode of the Real Estate Investor Roundup show. All right, so let's shift a little bit here. Let's talk about some current events. Now, lots of turmoil in the markets right now. The last couple of weeks, to say the least, Dow Jones, NASDAQ, S&P 500, year to date, all three of them are down. Okay, so how do you guys feel that that's going to impact real estate, or does it have an impact at all? I'll start with Christina.
Oh, man, I was ready to be second.
All right, Rich, come on, jump in.
That's so easily replaced.
She was being modest.
You go, babe. Go ahead. You're right. I shouldn't be modest.
No, go ahead, Christina.
Well, so I think that so personally, I think that the stock market has been the thing that to me is much more inflated than the real estate market in my mind. Right. So there's been such low volume in the real estate market that it's hard to get a lot of movement on price point when we really don't have supply and demand is not a numbers game. It's a balance game. We don't have enough supply for the amount of buyers. It doesn't matter if that's 10 buyers or 100 buyers. It really is that amount. So the whole volume being low means that real estate's actually been more stable than maybe it deserved to be, but it's served all of us. I mean, even single families have continued to go up by 11% in the last couple of years. Multifamily was the asset class that was hit the most in this particular interest rate rising. So I'm kind of not surprised that we're starting to see destabilization in a major asset class in the economy, and that the one that can be hit the quickest is the stocks. I also think, like I said, it was hyperinflated. How's that going to feed down through real estate? Well, the usual answer depends. Right? It depends. It depends upon how steep it goes. It depends upon how concerned it is. I mean, the concern right now that seems to have created it is really more having to do with the tariffs and the feeling of weakening in consumer confidence and the weakening in spending, and really the sort of economic uncertainty in general of what is the current administration going to do. I think the current administration is very, I'll call it showy, in trying to create changes in the economy. And a lot of people are finally like, yeah, we don't know what he's doing. We don't know if what he's doing is inflationary or de-inflationary. We're not sure where he's really going to land with the amount of layoffs that he's done. Every economic panel I go to, every time I go to a real estate meeting, it's been, well, what does this mean if he does tariffs? What does that mean? Well, it's increased cost in construction. Well, if he's going to do deportation, what does that mean? It means increased cost in construction. Well, what does it mean for housing? It means that we're going to have a lot less housing being developed. What does that mean to housing? Does it mean that it's going to fall off the cliff? No, usually actually it means it's going to stabilize it more because we already have a lack of volume. We already have a lack of units. So even though we're going to see the stock market have its own reaction, which is going to create potentially a recession based upon how long it goes on for, real estate might continue to stay cushioned due to its lack of volume, due to its lack of capacity to replace itself and the existing shortage we already have. But it doesn't mean it's not going to affect your renters.
There you go. That's a
the longer it goes on, the longer it cascades through, and the more layoffs we have because of the destabilization in the stock market. But it takes months for that to rotate through until it hits your renters and then hits your multifamily, which has already been struggling. Multifamily has already been having a hard time. It's already went down 20% last year, and they're saying that it's going to go down potentially another 20% this year because we're not seeing a decrease in the Fed rate, right? They're not promising to do multiple decreases. So I'm trying to keep it short. I'm trying to shove a lot of stuff into a very small amount of time. But I think watching what it does to your renters is what's going to be really important, because the asset itself is kind of buffered.
Mitch, do you have anything to add there?
Yeah, I have something to add, and I've been accused too many times of oversimplifying things, and I'm going to continue to do that.
I heard something today. I said keep it at a third grade level. That way everybody understands.
I think I make things overly complex. So go for it.
I love it. And we could chat all day long about the little nuances and speculate. And I absolutely love hearing, your perspective there. And I agree with almost everything you said there. Really, really great stuff. I'll say that I enjoyed this idea. I enjoyed the idea that with the stock market doing what it's done, the real estate market sounds, looks, and feels like the stable investment for investors, for people with cash. And when people are deciding where they want to put their cash, then putting it into our industry instead of what the stock market that is highly likely going to be highly volatile for the next few years. I like that idea. And I think it's going to serve us, our members and our fellow investors, a lot of our friends, very, very well.
Rich, you got your wish. You got to go third.
No, all great points. I just wanted to add, I spoke last week at my club and kind of touched on this a little bit. We have, a lot of people are calling him like a wild card in the office. Like Christina was alluding to, we don't really know how some of this stuff's going to shake down and shake out.
Is he crazy or crazy like a fox, right?
Yeah, it's like we could speculate it all to death and maybe one of us will pick the right answer. Who knows? But I just tell people, people are asking, they're concerned. Should I jump in? Should I not jump in? I just look, my buy box hasn't changed. I'm still looking for, rentals that I can make cash flow or turn into ADUs. I am still flipping mobile homes. I'm still flipping regular homes. What I'm telling people not to do right now is I would not go jumping into, if it's your first flip, I would not go jumping into $1 million flip with, $150,000 spread on it or something like that. I wouldn't go jumping into anything skinny. If you're brand new, I wouldn't, now's the time, not the time to get into like a brand new Airbnb. If that's what you've been thinking about doing, be careful. But if it's a good deal, jump on it. That's what I'm doing.
And that's a great point. Economies change, the mood changes. Bruce is always talking about the monometer, right? But the fundamentals don't, right? Stick to what what you do well. And if you've done something, your buy box is your buy box for a reason. Going outside of what you're good at, that's where people can get in trouble, right?
So if I may add,
jump right back in.
I think I try not have a political conversation. What I'm trying to have is an economic conversation, because that is the thing in which my asset class exists in, is a larger economy. And so I think that our current administration is looking to intentionally create inflationary and deflationary activities at the same time. And I think moving forward, people ask me about what am I going to do moving forward. I kind of agree with Rich, which is right now, it's not so much that I do or don't believe the intention of the current administration. I believe they're actually trying to create a balanced reset. I believe that's what they're trying to do. Whether they do or don't, whether it's successful or not, is a completely different conversation. And that's what I'm waiting for. The proof is in the pudding. And that's what we're going to see in the next, because basically every administration has about 2 years to get stuff done in, right? Because then mid-year elections can continue, drastically shift the House and the Senate and their capacity to implement quickly, right? So in this next 2 years, I don't know if they're going to hit the balance point they're looking for.
So, okay, so if it's not the stock market, or maybe it is stock market, what other indicators do you look at? Is it jobs? Is it, pricing? What is that, Mitch? What other indicators do you look at?
Yeah, definitely pricing. I mean, when we think about our renters, we talk about the people in our homes, the people that are planning to buy our rehabbed homes. It's all about affordability. Everything comes back to affordability today, and people are stretched. So yes, looking at CPI and what people are spending, where prices are going, is one of the big things that we hope stays in some type of control, because over the past 18 months or so, I bet we'd all agree that it's felt like a kind of a spiral that's been challenging us all, and the people that are either buying our properties or renting our properties.
Rich, what other indicators are you looking at?
I like to listen to a lot of people's different opinions on things, and try and figure out, kind of like on anything, whether it's economics, real estate, history, whatever, and try and figure out what I think is going to happen from my point of view. I definitely don't like pour over economic forecast numbers or anything like that, unless it's something that so the other day, this video was kind of going around the real estate circles about some FHA, about the FHA, the government paying people's mortgages for them and letting them do these massive reductions, and kind of creating this bubble of things that should have gone into foreclosure, but now they haven't, because they've been making these mortgage adjustments. Now, we're supposed to be for COVID, but now it's kind of, gone a lot longer than that. And so the video was making some claims that weren't really lining up with the article that it was referencing. So I started diving into the FHA data and just kind of looking at it a little bit. And I found out that, yes, overall, delinquencies are up like a little bit, like maybe a 1.5% from where they normally are historically, going back to the last 5 or 10 years. Are they elevated? Yes. Is it something that's going to crash the housing market? I don't think so.
We just put out last week, or was it a couple weeks ago, debt is up except for in real estate. In real estate, it's ticked up a little bit, but if you look at it compared to credit card and cars, it's nowhere near the levels of those types of debts.
Yep. So, I operate in a very small market. I keep an eye on that market. I keep an eye on the rentals. I keep an eye on resales. I'm very, compartmentalized in where I invest. So like I said, I have a very tight buy box. Unless I start seeing massive shifts there, I'm kind of seeing things happen because it is a smaller market, tertiary market. I'm seeing those shifts probably faster than some other people are seeing, so I'm already making adjustments there. I've already dropped my rents a little bit to get, a wider pool of renters, and trying to get those best people in there. So that's what I look at.
Christina, what other indicators are you looking at? I know you're a big data geek.
I would say all of them, but there's way too many to say all of them. I run out of time. So I really look at GDP growth, consumer confidence.
How about that outlook for this first quarter?
What in particular are you speaking about? The fact that the GDP's gone down, and that
did you see what the projection from the Atlanta Federal Reserve?
I did not, Joey. You got me on that one.
The projection for first quarter is at negative 2.9.
Okay. Because first quarter, what I saw was the estimated contraction of 2.4% of the first quarter. That's what I'm seeing.
Yeah.
Projection, right, which was concerns about a potential recession, which is part of why the stock market responded. But that the actual fourth quarter of GDP was, 2.3%. Following the expansion they had of the 3.1% in the third quarter of last year. So I really think I think they're in my opinion, they're over projecting the effects of tariffs. I think they're over projecting the effects of the deportation, in my opinion. I don't think that that's really going to slow it down that much, but the stock market responding the way that it has could slow it down that much. So the fact that the Atlanta has put that out now can actually create a cascade that would potentially be a recessionary quarter, and actually have negative GDP growth.
That's why the Fed always hesitates to say anything, right? Because everybody's like, what lever are we going to pull? It's like,
well, and they've been pulling levers. There's no question that they're pulling levers. I mean, they're not going to be pulling, like we said, they're not going to be decreasing the rate, but they are also decreasing their repurchasing of bonds. So they're doing the reverse of the quantitative easing right now, and that's on their projection list of what they're going to be doing. And that will start to create a slowing of pulling money off the market, which creates a slowing of cash movement, which can create a recessionary movement in money, especially compounded with the other things that the president is talking about doing or is doing, with the tariffs being kicked into place already. And, imports being more expensive and therefore the cost of living going up, being more expensive. So that is going to create that difficulty. As far as real estate, I still think that single family is going to be relatively well cushioned. And I'm doubling down on multifamily right now. I'm buying in Indianapolis and Tulsa. I'm out buying multifamily because I think that is what is going to be hit by having the interest rates not go down. They're already destabilized because interest rates went up. They've been getting temporary spending and doing capital calls in order to expand the note actually being called on them and therefore having to face a forced sale. I think they're going to be running out of time on that, but I'm not seeing very much of it in Indianapolis or in Tulsa. So we haven't gotten enough tired sellers yet that I'm seeing people accepting offers easily and gracefully that would fit with the current cap rates, or the cap rates actually expanding in order to fit with the current interest rates. But what I'm purchasing into is looking at the one area of real estate that has been affected that I want to own is multifamily. So that's what I've been doing on that level. So what am I looking at? I'm looking at CPI. I'm looking at gross GDP. I'm looking at unemployment. I'm looking at pending sales, volume of sales. And then, of course, you do look at price point for real estate, whether it's single family or multifamily, based on what you're looking for. And those all start to create a story, right? And I do look at the S&P 500 and the growth in that, and I do look at the stock market. But that isn't my primary asset class I invest in, but it is something that I am invested in, so I do track it. And I use FRED, the St. Louis Federal Reserve. I use their charts all the time to give me a feeling for what it is that's happening with that city, because I'm investing in 2 different cities outside of California.
As we start to wrap up, I want to get you guys' outlook for the first half of this year and where we're going to be in 2025 overall in the real estate investing space. Rich, I'll go to you.
Especially in my market, so I'm up in the mountains, San Bernardino Mountains. I'm in a tertiary market. I'm already seeing a shift there. I think that shift's going to continue and maybe pick up here a little bit. That's why I'm trying to exit some flips I'm in right now up there as soon as possible. I'm preemptively looking, lowering my rental rates on the stuff that I have vacant at the moment, just to try and get the best renter I can get in there, regardless of price, hopefully for the long haul. I think overall, there's gonna be a lot of shakeups across, I think, multiple markets across the country. But here in California, and the markets that, especially here in Southern California, is really a whole lot of what I look at. We still have a massive supply issue, which, we were touching on earlier. And, there's still, things are priced right, are still flying off the shelf. It's the people that kind of, are putting it up for these ridiculous numbers that are just kind of sitting and seeing these price drops. Orange County is still looking, insanely strong. Parts of San Diego, even parts of the Inland Empire. I know LA is kind of down a little bit, but even when I look at things are down a little bit, like they were already pretty kind of inflated. So, maybe we're just kind of leveling out here. I don't know if I really have a great guess other than, like I said earlier, that I'm anticipating that we're just going to kind of go sideways, like Bruce has been talking about for years now. And we might bump up, bump down, bump up, dump down, but we're going to be pretty, and I'm just making decisions based on that. I'm staying in the buy blocks and just making sure I'm not, getting crazy or you're going, off doing something that I don't know what it is, so.
Christina, what's your outlook for 2025 and the first half?
I feel like single family, like I said before, seems cushioned by the lack of inventory and lack of volume, right? So there's just not enough housing to house the people we want to have. But at the same time, I'm seeing affordability because I've been listening to Bruce, and I see the affordability index in parts of LA are hitting below 20. And that means that we're going to potentially 20%, which means we potentially might hit a destabilization even in the inventory we do have. 60% of mortgage rates are below 4%, but we still have 40% of those potential houses on market. And I think, like I said, in multifamily, it's going to continue to get hit this year, especially since we're looking at the Fed keeping interest rates up and the capacity to get that sort of interim financing, I think, is going to become harder during 2025. And we already know that office has been having a hard time recovering, and then hospitality seems to be relatively more fully recovered, having to do with people being back at it after COVID. But if we're going to have a decrease in the stock market, we're also going to have a decrease in luxury activity. So we will see what happens to hospitality coming in the middle of this year, because they really rely on that sort of summer season. And then I'm not a real industrial or retail expert, but I think industrial will still keep staying strong, because as they bring AI online, what they actually need is more space. And they actually will be creating more jobs as AI comes online. So industrial potential will continue to have a strong demand, having to do with the fact that we're still living with this high level of delivery, and we still need space for our greater areas of servers being able to have more and more AI. So it's kind of across different industries, but really I'm much more of an expert in single family and multifamily. That's really my area.
Yeah, I'm seeing that a lot in my area too. Out here in the Inland Empires, it's that what they call it, the final mile. I get warehouses in really residential areas now. In the valley that I live in. Last question that I have for all of you is, I'm a brand new investor, and this is my first day at your club. What advice would you give me? I haven't invested yet, so I'm looking to get in. Brand new, as new as you can get.
I say talk to Rich about his buy box. That's what I would say. Have a really clear buy box, right? The first thing you want to, I always tell people, the first 6 months of being new to investing, you want to go to every meeting you can, take classes, not the expensive ones, right? I won't mention some of the expensive ones. I specifically tell people, do not take these classes because they're way too expensive. They will take all your down payment in your class costs. So don't do that. But take a whole bunch of inexpensive classes like Bill Tan's class, or go to the exchanges out in the Riverside. Go to places where you feel like you're going to get educated, or NorCal REIA. Go to places where you feel like you're going to get educated, and just spend $20 going to meetings. $20, and get yourself involved in a community that you love, like, and trust. People who are willing to steward you towards having a network where you're going to be successful. And whatever you're going to choose, whatever you end up landing in, you're going to need a mentor. You're going to need people who can bring you cash. You're going to need inventory. So your network is how you survive. It is how you're going to be able to build. And you build your education at the same time. So spend 6 months building your education and building your network, and then find a real clean buy box and talk to Rich about your buy box, because he keeps doubling back to that discipline, because it is just a discipline to know your buy box and stay in your buy box, because your buy box is both what's happening in the market and what you bring to the market. That is your buy box. That's what gets merged to create a successful buy box for you.
Awesome. Rich, all right, I'm brand new. First time at the fire center. What are you going to give me advice on?
Yeah, really, Joey, I would tell you to, number one, stop being a secret agent. You got to, from now on, you are a real estate investor. Okay. When people ask you what you do, you're not a sales guy or whatever, or a mechanic. Today, you are a real estate investor, and you want to start looking for problems. We are problem solvers. So you want to start looking for people with problems. We're not looking for people that are just, need to sell their house because they want to. We're looking for people that have some kind of problem that we can help solve. Okay. So, and I give them, examples of what that would be. And then talk to your neighbors, talk to your colleagues, talk to whoever, like everybody you meet. You're a real estate investor. Do you know anybody that's got a house problem that I could help them solve? And then when somebody says yes, then you come back here and you find somebody to help you out. That's basically how this all works. We do a group coaching model, where we're all just trying to do this stuff together. So it's hard to, tell you this whole thing from A to Z right up front. But if you go find me that yes, I'll take you the rest of the way.
It reminds me of, a lot of stuff reminds me of things that Aaron or Bruce would say. But one of the things that Bruce always talks about is us as investors, we're in the starting over industry. We give people fresh starts. We don't know who we're going to help by buying that house, getting that cash and starting the next part of their life. So don't be afraid to ask. That's the one thing that Bruce always did. Like he was just successful because he was willing to take more no's than anybody else. So get out there, get active, and go change people's lives in this great industry that we're all in. All right, guys, I'm going to give you guys an opportunity talk about your club for how can they find your club, when can they attend, and how do they go about that? So, Rich, I'll start with you.
Yeah, sure. You can check out the Fire Center at firecenterhq.com. Like I said earlier, we do 15 meetings a month. The primary ones, we do Wednesdays from 2 to 4. That's our SoCal Exchangers meeting. And then we do our education focused with a speaker, more on stage on Wednesday nights, starting at 6 o'clock. So 2 to 4 on Wednesday. Just plan on being here Wednesdays, 2 to about 9 o'clock at night every Wednesday. Will change your life.
Mitch, how can people find NorCal REIA?
All right, NorCal REIA, norcalrea.com. There'll be a link in there to our school channel, which is our private online community, and you can actually sign up for either a month-to-month or an annual membership there. We also offer a 7-day free trial. So if you see a speaker that you'd like to see, go ahead and wait for just before that speaker speaks and get your 7-day free trial and see if the club is going to be a great fit for you. But best places to find us, we'll do Zoom meetings about 75% of the time. We'll have in-person events and mini conferences sprinkled throughout the year.
When are your meetings?
They are on second Wednesday of every month.
All right, Christina, how can folks find you?
So we're still on meetup.com. We're doing it the old-fashioned way. So we're still on meetup.com. That's where you can find us, and you'll find a PayPal link in there to be able to pay for it, so you can get a discounted ticket if you buy it before you actually show up at our front desk. That's FIBI Pasadena or ITI Education and Networking. Those are our clubs, and between those, that's 4 different meetings you can go to a month. So FIBI Pasadena is the third Thursday. ITI Glendale is the first Wednesday. City of Industry is the second Thursday, and El Monte which is all networking, is the last Wednesday of the month. So you can find all those on meetup.com.
Guys, thank you so much for jumping on the first real estate investor meetup, roundup, whatever we're going to call it. I really appreciate you guys jumping in. And guys, so throughout the rest of the year, once a month, we're going to do this. It's not always going to be the same folks. I hope that, maybe a couple times a year, you guys will be willing to jump back on with different people. So that would be really cool to have you guys on at different times, especially, please don't hesitate to reach out when you guys have something, maybe a little special coming up. You guys need a little help pushing that along, and, or just getting the word out, good time to jump back in. I really want this to be a highlight of what is out there, that there is a home for really anybody who wants to get started, and anybody who feels like they're just out there doing it on their own. There's a whole community out there waiting to support you, waiting to help you, and waiting to help you be successful. So thank you so much, guys. We'll have this out this Friday. Might be a 2-parter since we did go a whole hour, and it might not always be on the regular Norris Group slot. We might just release it separate, because I think this could be a really cool place where we could build some synergies. And who knows, we might even, I have an idea of even having a summit once a year where we could have you guys actually come out and teach a specific strategy, and we make a whole day out of it. So that would be really cool. Thank you so much for joining us. Good seeing you all.
We're here for you, Joey, whenever you need it.
Enjoy.
Thank you.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.